Hey all, welcome back, and today we are going to talk about dealer bankers or prime brokers, and we are going to understand some of the terms that are associated. So this video is for education and research purpose only, and the things that I have collected are based on the resources that I found on internet, so I don't claim the accuracy of the information that I'll be talking about. So when we talk about this entire domain of dealer bankers or prime brokers, we need to understand uh, the concept of shadow banking. We need to understand what are prime brokers. How does high frequency trading comes into picture here? What is rehypothecation? Direct market access, the counterparty risk, the dark pool and internalization and smart order routing. These are some of the terms that that comes into picture when we talk about the dealer bankers. So shadow banking is a system of collection of these non-bank financial intermediaries that provide services to most of the time hedge funds, money market funds, and SIBs. SIBs could be those CDOs, CMOs, and those kind of things. So shadow banking is where all this works, where bank provides services to hedge funds, over-the-counter deals, market funds, repurchase agreement, structured investment vehicles based on CDO, CMO, and all of these things. So the entire domain here is known as the shadow banking. This is very different from the conventional function of the bank. So if we talk about the retail part of the investment banking, that is again different, where bank provides advisory services to companies to raise debt or to go with an IPO. Those were the classical features of the investment bank, but in terms of the dealer bank, or to be more specific, prime brokerage, which acts as a service or which acts as a broker to the hedge funds or big institutional investors. So those services come under the umbrella of shadow banking. A little bit about this is being discussed in the FRM level 2 exam. They have some readings on the shadow banking, dealer banking. But what is more interesting to see here are the prime brokers. So these prime brokers provide services and advisory and also some quantitative models to those hedge fund clients whom they manage. So these hedge funds can borrow or can have trade implemented with these prime brokers, and the whole idea here is that they can get the hedge funds a better price for the deals. They can give them good research, but another thing is that they can give the hedge fund access to what is called the dark pools, and we'll look at what that means. But overall, the prime brokers manage the risk. They manage all those risks with their fees, and they take care about uh, doing those repo agreements with the hedge funds, or taking custody of some of the assets of the hedge fund to give them a loan so that the hedge fund could lever up. And they also provide help in the algorithmic trading world, or the high frequency trading world to be more specific. So there are various risk models for these prime brokers, and these risk models are based on the kind of loss that they could incur when they lend to the hedge fund. So in the time of recession, where liquidity was short, uh, the assets that the hedge fund had put into the custody became worthless. So these banks were in trouble those times. So the U.S. government came and supported them with TARP, and they gave them liquidity. So there are some quant models on how this would work. I have collected some links on the OTC part here, but I'm not going to go in them in this session. Probably some other time I'll go in there. So high frequency trading involves execution, clearing, and financing, and most of the prime brokers give their clients this service. So high frequency trading, it's a way to put in all those orders or understand or provide liquidity to the system, but many of these orders that are put up, I think they are cancelled, and they can be cancelled at a time, and uh, in a way they provide liquidity to the system, but when things go wrong, it it might become out of control, like what happened in the flash crash when the market fell down. And it happened because these algos, every algos that uh, the brokers were using were like don't sell, don't sell, don't sell. So the liquidity went out and the prices went down very rapidly. So there are some advantages and there are some risk in this high frequency trading domain, but in all it's about trading very fast, and putting in an order or cancelling in an order or flooding with an order or things like those could be done. Then there is something called rehypothecation. There are limits to this in US, but I think it's more liberal in UK, where you can rehypothecate your asset, which means that uh, when a hedge fund gives some security to the bank to get those loans, the bank can then use these securities to make their own proprietary bets. So in a way, if this asset fails, uh, the bank's trade also fail, and this is a kind of a chain that goes on, and this is where reliability or risk engineering comes into play, and this is how things were moving. So if a hedge fund, they wanted money and they went to these prime brokerage service providers, and they gave them a collateral which was a mortgage backed security, and the bank kept this, but again the bank gave this to some other dealer banker to make a proprietary bet on some other thing, like some credit default swap or something, and then he passed on. So, and this was the security that was initially used uh, to back the trade, or to back the loan that was given to hedge fund was being transferred. So if this security goes down, or if something happens to this security, there is a chain of event that would come into play, and that's where this rehypothecation needs to be uh, taken care of, and risk needs to be managed there. Then there are some direct market access techniques which provide low latency, and which also allows you to pick those big orders. One example here is the sub-MDMA by Barclays. I have included the link. So in all those things that we just talked, the FRM Part 2 exam has got some interesting things which are like dealer bankers, counterparty risk, which are like those models of market risk, those fat tail models, operational risk, which these dealer bankers could face. So much of it is in the FRM level 2 exam. Let's move to the dark pool. So the dark pool is a volume or a liquidity that's not available to the public. So parallel to the exchange, these prime brokerage services have these dark pools where large trades could be executed in an anonymous way. So nobody knows who is trading, what's the size of the block, and they could trade. So it becomes helpful because when you go into the market, when you say that you have got some order of a size and you are ready to buy it at this price, the price of that thing or that security would increase in anticipation. So you have to break down your order and do a systematic trading so that you don't drive the market in one particular direction. So in that ways, dark pools give a better alternative to implement the same trade. And then we have the internalization, which is again very same as those dark pools, where bank could use those securities which the bank has and could execute the trade if they believe that that's a good bet, rather than going to the market where your price would actually disturb the prices. So in a way, this is not good for the retail investor or those investors who have access only to these exchanges, because they're not going to get the best price and they cannot use that supply demand force to actually get the right price, but all these trade gets executed either in an internal way or in the dark pool. So but in a way, this is good for uh, those big trades where they cannot afford to pay a high price, or they are concerned that they would drive the market and create an unnecessary boom or an upside move in the market, which is not really required, or which don't really reflect how things should work. So there is a debate on this, on dark pools, internalization, and these trading techniques. And there are some smart routing algorithm that are provided by these banks, again to get the most liquidity out of the system. So to get the best trade executed, and all of this is also linked to the technical analysis. So that's one area where you can check some things about the automated trading and the technical trading, where these high frequency or these algo trading ideas are implemented. So there are two dimensions to this. One is the technical part, where you'll say that there is a trend being follows and you're going to make bet on that, and there is another part where you have the pricing of the securities. So you are writing an interest rate swap or a credit default swap and getting a premium or playing on that, but that notion is based on the pricing of these instruments, like using a particular interest rate model, or if you believe the market is pricing those swaps in a wrong way or in an inappropriate way, and you believe that these pricings don't reflect what they should be. So keep these two dimensions in a separate way, the technical and analysis part and the derivative pricing, or the OTC market, where you can really take on those derivative bets. So this was all. I've tried to collect a lot of references, and in some time I'm going to get more stuff from these references and increase the details of my video.